Hello and welcome. You're watching Leaders Briefing, a regular quarterly insider into the market's expected logical as well as illogical moves. This time around, it is a special edition. We are at the new chateau of the Kinsky family in the Czech Republic at the 6th Annual Economic Forum dubbed the Central European Davos. The theme to be tackled over here is the future of European industry in the context of the jump-started transformation of the global economy. And given the relevance of this issue as well as our partnership with the event, we have decided to dedicate the current briefing to this very topic. The brief's creators, economist Raffaella Tenconi
and brilliant global strategist Roman Chlupatý,
wish you an inspiring session, a session that, as always, shall start with a market update with Raffaella.
Good morning, everyone, again from my side. So let me give you the market pulse on the basis of what is being pricing in the market and our analysis of language in the key Bloomberg news segments. What we can see is the market is still trading largely bullish. Okay, the economy, US economy, is still giving out, broadly speaking, very robust numbers. European data is mildly positive as well as in the UK. So the market has a clear bullish bias, both for US equities and European equities. What we have noticed is that creeping in the last few months, but more acutely over the last week or 10 days, we see that there is more discussion about extreme negative events. These are still mild, so I would still say the market is trading bullish. But we have noticed that both scenarios where there is a hard landing in terms of economic growth, or that US equities, US yields spike up, so that the Fed either does not cut or loses control of the long end of the curve, are being raised. So again, this is more considering tail risk. I would say it shows that there's still a lot of confusion. You know, we've been 2 years into the outbreak of inflation. And we notice also when we discuss with institutional investors, there is still a fundamental uncertainty about how inflation behaves and therefore how the inflation outlook is going. In terms of market pricing, the market is still hoping to see rate cuts sooner rather than later. So we're discounting 50 basis points of cuts by the Fed and about 80 basis points from the ECB.
Now, interesting themes. Let's tackle them one by one. Speaking of rates, let's start with that. Where do you think we are at the moment? Meaning how likely it is really that the hope of the market you just mentioned is going to materialize by the end of the year? Because at the very beginning of the year, it wasn't one cut, it was subsequent cuts that were supposed to already be in process, let me put it this way, and slightly as if we were cutting a salami, you know, slice by slice, we got to a position, to a state where part of the market, and not an insignificant part of the market, says there will be no cutting rates this year. So your take. And what should we watch? Because as you've mentioned in one of the previous sentences before you tackled the rates issue, you said it. At the moment, there is a lack of clear signals at the market. So where do you look for a clear or clear-ish signal?
So the simplest answer I can give you is the clearest signal is in the labor market. That's what is going to trigger the adjustment. Fortunately or unfortunately, we live in a business cycle that has very long lag, abnormally long lag, because there is still a shortage of labor, both in the US and the Eurozone. This is just making all of the adjustment much slower. But you're absolutely right. I mean, we ended 2023 with market pricing over 120 basis points of cuts by the US. And we keep on bringing it back. In fact, at some point recently, we're actually actively looking into rate hikes, right? And then Powell, in the last press conference, kind of made that clear that that is very unlikely. Personally, I still believe rate cuts are happening, both in the Eurozone and in the US. we actually expect 75 basis points of cuts this year. But what I would say is it's comfortable with saying 100 basis points over the next 12 months, plausibly starting in September or October for the US, whereas the ECB will start in June at 25 basis points pace, and maybe not every month, but every other month or maximum every quarter will deliver a critical amount of easing that allows the recovery to reaccelerate in the Eurozone and a soft landing in the US.
You've mentioned a crucial issue. To me, the reading is pretty much the same. To me, it is all about the job market at the moment, more so in the US. There are some signals that say, and for instance, in the course of the recent earnings season, it has been repeated again and again by the representatives of big corporations. There are signals that the American consumer is losing the momentum. Now, I know that we discussed this more or less a year ago already, and there were some signals, but how do you read it at the moment, given all the other issues? Is it something that could derail sort of a central scenario, including the one about cutting the rates by the end of the year?
So a year ago, we were beginning to pick up the softening. It went from very tight to gradually losing steam. And indeed, you saw it in slowing wage growth in the US. Now, because we have April data, what we see is that if you take the cumulative amount of unemployed in the US, that exceeds the cumulative amount of employed over a 12-month period. So they added 600,000 unemployed last year, and they generated 450,000 positions. So this is the pivotal moment. There is still a very important question about timing, because we think in any case it will take at least another good 6 months before these lines continue to cross, and the number of unemployed is big enough to create unemployment rate, right? And because we normally, that the US labor market never soft lands, once it starts, it really skyrockets. So we think in any case next year you will see the unemployment rate above market expectation in the 4.5% range. I think when in the last episodes of the leaders briefing, we discussed the importance of wealth effects, especially for the US, right? US households have very high exposure to equities. As long as the S&P is doing very well, there is, 20 to 40% of the population that has such a dominant positive effect. And this is reinforced by the fact that globally we're recycling savings into US equities. So this loop is very hard to stop. What I think we should discuss, because it's very pressing now and very relevant also for the issue of competitiveness going forward, is that first of all, the critical moment is when high professionals will get laid off, if they will get laid off, because those are the ones that have wealth and indebtedness that indeed can change the outlook for the economy. So I personally expect that you will see some higher educated job losses, maybe by end of year, early next year. And that's when also the housing market is going to begin to soften as a result.
This is one, probably the key risk. Let's look briefly at the other risks that you actually do follow. Of course, there's politics and geopolitics, something that we regularly discuss, and we're going to get back to it. So from the sort of economic and business front, what is it you follow at the moment? Where can be, or from which side it can come something that will surprise the market, both in a positive or negative terms?
So very, very closely related to what we said. First of all is the question of pricing of political risk and the outlook for interest rates at the long end. So market-driven interest rates. What we notice both on the basis of models and on the basis of language analysis is that the 10-year part of US Treasuries, the sovereign yield curve, is trading above its macro fundamentals. There is already a 30 to 50 basis points of premium in there. Now, whether it's the local elections or whether it's the geopolitics, most likely the intertwining of that, that's already there. So from our analysis, the risk is that that risk premium increases going forward. That's where really the bulk of the probability lies. The second issue lies with the behavior of inflation, because on the one hand, we now have had a disruption in the Suez Canal for several months. So eventually that spits into inflation globally, and that is going to be magnified or not, depending on the strength of demand and the pattern of energy and food inflation. So I think that part is also what is compounding the uncertainty around inflation, because fundamentally there is no strong direction, it's simmering. So every small hiccup can be up or down and changes whoever already has a view. But more profoundly, what is happening is, because we live in a world where machine learning pricing influences inventory management and pricing strategies, and it works perfectly well the more inelastic is the demand. So higher income consumers are fundamentally a more inelastic demand, right? So that's what is driving a lot of the inflation stickiness right now.
This definitely deserves some closer attention. So let's look at the inflation from the mid to long-term perspective, or rather, let's look at the sort of trends that will most likely stick around no matter what, quote unquote. We already talked about issues such as energy transition. We talked about demographics. These all things actually do or are inflationary. One thing is to what extent the ECB, Fed, and others can actually fight with the current issues that actually cause inflation to be higher than usual, let's say. The other thing is to what extent these long-term trends will keep the inflation higher no matter what. So when I ask you about, let's start with the sort of a new normal. Where do you see the new normal when it comes to inflation rates and the ECB, Fed, and other big central banks' rates?
Mm-hmm. So let me start first saying something that I really want people to have clear in mind. Inflation has its cycles. It's a bit like love. It moves, okay? There may be an underlying trend, but you cannot underestimate that it will continue to follow a cycle within this trend. So this, to me, is very important, because you will probably hit the bottom of the measured inflation rate in the second half of this year, and only slowly will reaccelerate probably next year. Okay, and that is going to be where the market is going to focus very, very near term. But you correctly asked me about the long term. So if we want to have a simple number in mind, I would say you should add easily a percentage point, maybe 2 percentage points, to whatever you had in terms of average inflation in the last decade. Meaning that Eurozone inflation was slightly below 2%, it's now going to be more likely to be 3%. It could be higher depending on what is the unfolding policy towards credit. Okay, and in the US, instead of being in the range of 2.5, it will easily be in the 3.5, 4 range. Again, it could be higher depending on what is the fundamental credit condition in the economy. So this is where it will really boil down to. In terms of what drives the inflation, I think it's helpful to break it down into chapters. The very near term, so the 12 months, the 15 months, is hugely influenced by energy and food. That is the biggest weight. That's where you're going to get the shapes. Then it goes into demand and housing. That's actually where we are really now. We still have some demand pressures. We have some housing reacceleration in the US. And then where it starts getting stickier is because it's heavily shaped by productivity. And productivity can be just business management sophistication, which is absolutely very important and normally has a 3-year life. right? So if you got better for 3 years, you're going to get some disinflation. If you got worse, you're going to get stickiness. But then in the 2 to 5 years part, that's very much market structure, right? And market structure in the US has significantly been concentrating. So that is a kind of productivity that you're not going to really get back unless, for incredible reasons, digitalization and AI really generates an enormous boost to productivity, and we can discuss that separately. And then the final leg of inflation is really ideas, because we are in a society of people. We respond to each other, and we respond to dominant ideas that then feed into policymaking, which feed into the effectiveness of institutions. So the biggest challenge that I see now, and has become more acute at any point in time in the last 3 or 5 years, is that we have the concentration of markets, but we are not sufficiently tackling how we're going to break it up. We still think and we deploy policies like the economy that was more competitive before, but we have fundamentally changed the market structure. So this is exactly where the problem is. What is the right monetary policy in these conditions? Are you going to be too tight because you want to kill the economy in order to force de facto monopolies and oligopolies to price below that? Or are you going to overstimulate the economy because the majority of the individuals in society are suffering and you're trying to keep social peace together?
Which, by the way, goes for a lot of small and mid-sized companies as well, right? I mean, now it's a lot about the big guys, the rich, the riches, and the rest. And that's probably one of the stories one should actually follow, even vis-a-vis the market condition and the future development or direction the market is going to go.
I think you've exactly hit the right point. I think, and I observe actually from the polls that we conduct, that households and entrepreneurs completely understand real competition, completely embrace competition. You ask any entrepreneur, they would say, there's somebody better than me, let's take it on, let's show whoever is the best one. But there is an unspoken understanding that beyond a certain point, it becomes unfair competition. It's not viable, it's not the same rule book, and that is not desirable. The problem that we have is that when we have financial markets, this kind of language is not exactly used, is not welcome. Ultimately, if you are at the same time a pension holder, you prefer to have oligopolies with stable revenues, or even better, wannabe monopolies, right?
Exactly.
So the financial markets, which ultimately deploys the wealth effect and the credit conditions, de facto does not have in its own DNA anymore competition. The population understands this and expresses in part the frustration with the lack of competition with parties that seem to respond better to their own complaints. And you have a vast part of the establishment in politics which is just not picking up the right memo.
Which is one of the reasons why we're now observing the fragmentation along various lines. This is one of the lines, and I think that one has to add one more ingredient, if you will, and that is power politics, power interests. At the moment, the way the world operates, if you will, the global economy operates, if you will, is changing. We had more or less, now this is slight simplification, but really slight, for the sake of our discussion, we had one center of power, and that was more or less the West or the United States as such, that were essentially to a very large extent authoring the global rules and then policing them, right? Now we are becoming a world of multiple power centers, and those power centers need to nurture their tools that they use actually to get their whatever they want. And the tools, one of the most potent tools, is the technological companies and their might. So at the moment, you see both in Washington and Beijing, and by at the moment, I mean for the past couple of years already, you see this love-hate relationship with big technological firms that was much clearer not a long time ago in Beijing, but now lately with all the regulatory attempts to actually lessen the position, the privileged position of the US technological companies. You can see it in the US as well. So on one hand, the capitals love their technological companies because it's the way how to actually see the world, how to an extent even control the world, as we've witnessed in the course of the past couple of years vis-a-vis Brexit, the previous or second to last American presidential elections, and so on and so forth. And on the other hand, even the politicians fear the might of these technological companies on the domestic front and their representatives. I mean, people like Elon Musk, to use one particular person, of course, are, from the perspective of politicians, if nothing else, then problematic. So at the moment, we have this very chaotic situation that if you break it down into even the smallest numbers, you still see the smaller number has, or the smallest issue still has the sort of a yin and yang factor into it, and is fighting. The yin is fighting yang and vice versa. And that all creates the situation where, and we're back to square one, meaning inflation, many companies actually opt for resilience, not margins. You know, the sort of a toy on word which I love, it's not the just in time at the moment, it's the just in case kind of a mindset. And that means that you have much more reserves, you are getting ready for anything and everything, and that is costly. So even from the sort of a political and geopolitical side of it all, you see inflationary pressures, and these are not going to lessen. We have to get to whatever it is going to be, the next chapter of globalization and the world as such, and then maybe this will lessen, but not sooner, and this will take years.
Absolutely. I think you can probably say that comfortably it may take a decade, because it's definitely going to be longer than that. I mean, I also think, on the basis of what you said, because things are pivoting very slowly and they're not so in your face, right? Because we have the demographics shifts, you have this power politics, and I think there is also a question of who is loyal to who and who will be the winner in this game, right? Because we live at a time when you have people as wealthy as countries, companies as large as G7 countries, and I think a genuine understanding on whether the old-fashioned state being the most important and powerful institution in the global economy is being questioned. You know,
you are absolutely correct. I mean, again, simplification, but during the Cold War, all the other actors, meaning non-state actors, were somehow less important, even though we know that, for instance, when it comes to armaments, the NGOs were playing a crucial role, crucial part. Both the USSR, Soviet Union, and America were outsourcing some of the negotiating power onto the bodies of scientists, for instance, because they spoke the language of science, and thus they were largely apolitical. So even back then, there were institutions and organizations, non-state, that were playing crucial role. But at the moment, as you said, you have a playing field where you have NGOs, you have corporations, you have individuals, you have organized crime from many places, including Central Eastern Europe and Italy, which again is partially historical, but at the moment, given the volume of this illegal trade, they are major players. And because we are redefining the rules of the game, of course, all these players try to take a bigger piece of the pie, of the next pie, the pie that is going to, or is emerging and going to emerge in the couple of years. And that will create, again, unfortunately, a lot of violence. We witnessed, unfortunately, a lot of political violence lately. This shall continue. It will be a source of violence even on the state level, let's say. So I expect more wars and more generally armed conflicts to create. Again, that is somehow defining what the economy is going to be or not going to be about. More and more, even in Europe, some politicians talk about war economy, that of course, should it materialize, will somehow influence the inner workings of individual economies as well as European economy as such. So there is a lot of things that are abnormal if we actually look into the rear mirror and look at the past 2 decades or so. But I think it's more normal if you look at longer trends, that the past 2 decades, or let's say even 30 years since the fall of the Berlin Wall, were somehow abnormal in a sense of economic growth, security, rising living standards almost everywhere, even though, yes, inequality within states was increasing. And now we're going back to the life as it used to be, meaning much more volatile, much more unpredictable. And that's something that one has to, of course, reflect, among other things, in his or her portfolio business and so on and so forth.
Let's stay here on this question of normality with a longer time frame versus abnormality in a relatively short time frame. To what extent do you expect the effectiveness of these trade barriers that the US and Europe is trying to increase, especially with China? I have to say, it appears that sanctions against Russia is the legal tool, but consensus seems to be they have been largely ineffective. What do you expect to happen with China?
It's a very good question, one I don't have a definite answer to. I think that very few very few questions of this magnitude actually can be answered full stop. We can plan in scenarios, we can talk in possible scenarios. That is more likely, that I think is a healthy approach. When it comes to China and sanctions, I mean, and Russia and sanctions, I mean, we still do not know to what extent it really is a tool, a potent tool, a tool that actually works. There are arguments when it comes to sanctions on Russia, there are arguments that support the idea that it is a potent tool, that it makes sense to actually sanction Russia and some of the individuals and companies. And of course, at the same time, you see that it's quite porous, right? That just using a simple re-export a lot of goods, find the final destination, meaning the Russian market. And I mean, it's one of the problems that one has, and it's quite natural with sanctions. On the other hand, if I were to simplify the story, you need to do something, and there is a very limited scope. There is a limited arsenal you can employ or deploy when it comes to a country such as Russia, right? Moreover, for the Russians, because they weren't really an integral part of the global economy, if we compare it to, for instance, China and the way it operates, its role within the global economy, Russia was essentially on the fringe. It was mostly exporter of oil, gas, and generally mineral resources. And historically, it is known that it's quite easy to reroute these kind of channels, right? These kind of straits. Once you are actually more sophisticated manufacturer, once you're part of the globalized finance and so on and so forth, the sanctions could be much more painful for you. At the same time, you can inflict more pain. So if I were to answer your question in probably 2 or 3 short, brief comments. First of all, it's not an omnipotent tool. I mean, at a certain point or certain instances, I think that it's legitimate and correct to deploy it, to use it. But at the same time, it shouldn't be just a barrier to protect your national champions, and that's it. You know, there are many things we should be doing, and we are not. That would directly or indirectly probably help, for instance, the European industry. Since we're in Kostelec, we're going to discuss European industry here. It would help much more than sanctions or any kind of barriers. I mean, look at infrastructure. Almost anywhere in Europe, it's heavily underfunded. I spent 3 weeks in, and we talked about it, in China. And I mean, right now, if you look at the narrative, it's in China, you have these ghost towns, and meaning empty apartments, you know, hundreds and thousands of empty apartments. And when they build something, it's crumbling because there's no quality. Quite the contrary. I mean, there are many problems. Don't get me wrong. I'm the last one who would say China is perfect. But their infrastructure compared to almost anywhere in Europe, and I'm talking about the coast, okay, just to be fair, but that's where most of economic activity is. Their infrastructure is on a very, very high level, and they're ready for the next episode, let me put it this way, for the future, both when it comes to digital, when it comes to hard infrastructure. So let's invest into infrastructure. Let's finally, and you mentioned it, you know, the global wealth is being recycled in the US. Let's work on European capital supporting European companies, industries that are strategically important. And again, it should be more about the market and less about politicians saying, do it. But there are certain things you can do to essentially create the environment that is forthcoming in this sense. So that's number 2. And number 3, the sole DNA of the global economy is changing, not only because of the power struggle of these 3 centers, meaning primarily Washington, Beijing, and Brussels, let me put it this way, and of course second-tier powers as well, because New Delhi and others are already also playing a significant role, and now we're sticking just with state actors. But at the same time, it's about how developed certain countries already are. They are naturally moving up the value chains. You know, their workforce is smarter, asks for more money, and so on and so forth, and that naturally changes the very soul, if you will, of these economies, and they're looking for naturally for their next role in this global charade. And that should also be reflected and worked with. And I think that we're failing to a larger or lesser extent on all these 3 counts.
I couldn't possibly agree more with you, but I would say let me use this moment to add a small reflection also on portfolio management on the basis of what you said. First of all, things appear calm, but there's clearly these tectonic shifts taking place. It just so happens that right now you could buy protection against extreme events on the market for very cheap. So I would highly recommend that this is exactly the time to do it. Of course, you would be leaving a little bit of profit on the table, but in exchange for protection of something
that's the just in case. I mean, something can go wrong.
Exactly.
And it's pretty much up to you as a manager or a person if you actually want to accept that risk or not.
Exactly. So, you know, we do just in case in production. Let's not forget about just in case in financial management. Second of all, it's clearly taking stock of the reality of these mega trends. You know, I mean, the wealth is being created on margin faster in EM, in India, in China, in MENA, rerouting of trades, benefits, CIS. This is a reality that will be with us. And also, since we're going to talk also about car sector and competitiveness in Europe, you will need to accept that. You know, that's a slow process that needs to be embraced. I would actually like to go back a second to what we were talking about before and go back to the US on how there are these power changes and new power centers that are not state. Because the question is, and I'm posing what I heard, you know, being raised in Bloomberg, there is legitimate question about the sustainability of US public debt. So whether it comes because of a hiccup in budget finance or whether it's a hiccup in geopolitics, let's assume US 10-year treasuries go to 5 or 6%, which we think is a completely realistic scenario. At that point, who is the better creditor? Is it going to be the US or is it going to be Indivia, for example, which is the winner of the AI revolution?
It might seem like a provocative question, but I think it's quite legitimate. When it comes to the US, I think at the moment it's the proverbial one-eyed king in the kingdom of blind. And you've mentioned Bloomberg. Bloomberg did a fairly thorough modeling of possible scenarios. I have a feeling they went up to almost 1 million of possible scenarios. How could the US debt actually evolve? You know, what are the possibilities, how it's gonna play? And vast majority of these scenarios ended up with some sort of the word crisis is overused, but problematic scenario, let's say. Let me put it this way, some sort of a problem. So you have both the rigid models as well as people who are quite experienced, that they already experience a lot on the market, such as my favorite Ray Dalio, saying something's not right over here. And now we're on this trajectory, on one hand. On the other hand, or not other hand, but the second factor you have to actually factor in is that 40% of US debt historically has been bought by outside forces, meaning mostly sovereigns as well as some market players, of course. But when it comes to this 40% that has been a fairly solid customer, and look at India and Saudi Arabia and China among all, or above all, they all decided to lessen their exposure towards the US and financial instruments, among other things. And that goes both for the US dollar, you know, the central bank reserves and so on and so forth. That's, by the way, one of the reasons why the gold is where it is right now. Because they don't trust the US, but they also don't like each other's currencies. So absolutely, at the end of the day, it's all about gold. It's not that that China is now accepting Iran's rial or whatever and keeps it on its books, right? So that's one thing, that suddenly all these former solid, trustworthy, reliable customers are less and less interested in the US debt. And at the same time, on the domestic front, the society is so polarized. And by the way, the US presidential elections is just putting this on, you know, on steroids, that it's very difficult to say, and now we're gonna lessen or we're gonna decrease some of the funding for social projects and other things that people are quite sensitive to. So it almost looks like, you know, a car that is speeding towards in a dead end road towards a wall, and presidents are taking turn at the wheel, and each says, "Oh, the wall is still not in front of the car, so I'm not gonna slow down, even not stop, but I'm not gonna slow down." And now the question is, once the wall is right in front of the hood, what is going to happen? Again, still U.S. debt, solid investment, but I would say short, mid-term. Longer term, there's a question mark for me. And it's a lot about politics. To what extent the US, the next president already probably, is going to start working on this issue or not. And at the same time, politics, international politics, meaning to what extent the emerging markets primarily, but not exclusively, are going to really work on this attempt to, or further the attempt to decrease the exposure towards the US and more generally the West.
I would take what you said about the natural buyers of US treasuries a step further and say, let's not underestimate that, especially in the last few years, one new large buyer of treasuries were corporates, because we created maker companies and they needed to manage their own treasuries. And the delta on this is really significant, because when you look at other buyers of US treasuries, it went from 500 billion a few years ago to 4 trillion peaking last year. So on margin, this was really significant, and it made probably the bond market significantly better behaved than what it would have been. And now with the AI investment cycle in full throttle, that is another natural buyer that you have lost. So I would actually say that, yes, of course, the US treasuries remain a safe asset, and nobody's going to displace the dollar anytime soon. And when I say anytime soon, comfortably 5 years, and more likely a little bit longer than that. But that you will see yields rising in a disorderly way, assuming the Fed does not bring QE. It's not a medium-term risk. This is a 24, maximum 36 horizon, and it doesn't have to hit that far. It's any point between next year and up to 2 years in there. I think you will see challenges in the yield curve, exactly because any small slowdown in the US economy generates so much extra issuance, and there is no natural buyer of it.
Long story short, Raffaella, looking forward, next quarter of a year, next 3 months, what is it you're going to pay attention to? What are the sort of indicators that something might change, you know, and now we're back to square one, meaning there is some center shared take on what is going on and where it's all going to go in the next, you know, months, if not.
So, as we said, in terms of economic data, the labor market is supremely important. If you are in Europe, it's worth paying attention to the fact that on margin, hiring appetite has been slowing. And if we do not see a genuine recovery in exports by year end, you could be ending up in a much worse outlook for next year than anybody expects. I am not in that camp. I still think that, you know, because Chinese stimulus is coming through, because the ECB easing is coming through, actually next year you will have a definite improvement in the European Union, coupled with some soft landing in the US, but that's definitely a primary focus of attention. The second focus of attention, in my view, is really what happens with the European elections, which take place in June, you know, 8, 9 in every single European country. The opinion polls suggest that you'll probably get continuity, or more continuity is more likely than discontinuity. And that has the advantage that continuity will mean that the path towards energy transition, the path towards higher defense spending, the path towards capital market integration, which is a very big topic, maybe for next time, will gradually unfold. The bad news about it is you will have the same people that have been stubbornly fighting with some of these latent issues, which ultimately are becoming a priority. So it will feel better initially. It may not be sufficiently good to address the medium terms. And you know, very important. So if we have the US where political risk becomes more priced into the market, to what extent that is gonna be also expressed in European debt, and that is of course a function of the unity of the European Union, of course. But more long term, you know, I mean, we discussed sanctions before, and of course sanctions are porous. History shows nobody wins in a war of tariffs. There is just, at some point, the pain is high enough on both sides that we end it, but it takes years for doing that. But look, we live in a world of globalization of ideas, globalization of services. So you want to be a winner, you need to be a good influencer, right? So where is that gravitas of the European Union towards the globe? The European Union still has gravitas in the majority of voters. You look at the Eurobarometer, it is evident that the majority of them see in the European Union peace, democracy, and respect for human rights. This is its strength. But first of all, that's not the perception that the rest of the globe has it. There is a fair amount of skepticism within the European Union on whether that is true. And in my view, a huge evaluation test is whether the European Union honestly has consistent implementation of its values to the rest of the globe. And let's be very outspoken here. What happened in Gaza? You know, is somebody's life less valuable to others? Because you could have been more inconsistent in a more closed economy, but you cannot be consistent in a globalized in terms of transparency and perception. Because sooner or later, we will have more means of payments, we'll have more currencies challenging the reserve currencies, and ultimately what defines use of that currency is whether people perceive the values and the security of that currency to be genuine to them. This is the hardest bit of this evolution that I think we need to engage in.
I think this is a very important issue, and it's good that it's coming from you, meaning economists, that we share this take on the subject matter. I'll use a shortcut. Ian Bremmer, who I found to be one of the most interesting political scientists in the US, and he's generally considered one of the best, shared a very interesting take on the subject matter on his Twitter account. He put a map that reflects the position towards the two-state solution of the conflict across the world. And you essentially see that all the countries but the Western ones, and not all of them, supported two-state solution, meaning Palestinian statehood. And his comment, one sentence, was, the West is on the wrong side of this one. I agree, and I think there are conflicts around the world that are going to decide the map of the future, meaning, not only who's going to be whose friend when it comes to politics, but to a very large extent, and these are connected vessels, who's going to trade with whom, who's going to, as you said, respect the other's currency as a reserve currency, and so on and so forth. And these will be decided not only according to the hard economic and business interest data and logic, but as well as or by the approach towards the softer issues, such as this one. So if you were about to ask me what I'm going to follow, well, it's definitely the Middle East, not just the Israeli-Palestine conflict, but of course what is going on in Yemen and other parts, the way Iran is playing its own future, let's say, or planning and trying to actually follow this plan. It's about Ukraine. Are we going to actually unite? Are we going to support it? Because now it seems that the war is in this sort of a breaking point. And there are many other issues that are larger geopolitical or would fall within more security than other ranks, but have clear implications. I mean, let's say choke points. And you've mentioned that this is the part of globalization that is about ideas. So one thing is choke points when it comes to maritime transportation, and we already discussed it as well. Look at how the ideas are being spread. It's the internet cables, maritime cables, and it's satellites. And both, if you look deeper into the issue, are now areas where a lot of interesting as well as dangerous, both security-wise and economic-wise, issues are being played. So there are clusters of both hard and soft issues that we considered normal or didn't even think about those for a very long time. And now I think it's part of the game. You need to think what used to be air for you, things that you didn't think of but were vital and are vital for your life. And you need to question whether they're going to stay as they used to be, meaning something that you could ignore without actually potentially paying the high price. And we're back to square one, the beginning of this interview or this debate, meaning, now it's about just in case rather than just in time, meaning max margins. Because this is still a legitimate game, but can become very costly in this kind of environment.
Absolutely. I would like to make my final remarks starting from one of my favorite philosophers, Karl Popper, which said, life is all about problem solving. Okay. So there are three approaches to complexity, because this is what we have, extreme complexity. Ignore it. These days, ask ChatGPT, or mix and match what is old instruments of deep analysis and more sophisticated information to try to monitor complexity and have a realistic approach, but still a hands-on approach to what are scenario building. So we at the Leaders Briefing, we're going for the third option. We think that is definitely where science actually still gives you the best outcome. But we tool with ChatGPT all the times. And I think, fortunately, unfortunately, but let's take it, has a reality that more and more you will be able to go to ChatGPT, ask any question and get an answer, and an answer that is charmingly convincing. So I think this is one additional layer of complexity which is compounding also the confusion. And I think certainly from our end, it appears that what looks like a simple solution is hardly ever the final one.
Amen to that. Ladies and gentlemen, this was a Leaders Briefing from Kostelec, from the Economic Forum at the new chateau of the Kinski family. As always, brought to you by economist Raffaella Tenconi
and brilliant global strategist Roman Chlupatý.
We wish you all the best, and in 3 months, give or take, we're going to see you again in this kind of a setup. Goodbye.
Goodbye.